hard surface. Ritu Arora joins us, CIO with Can Bank, HSBC, OBC Life. Ritu, good afternoon. Thank you for joining us. For a market which looks like the best market on paper is suddenly the worst performing market in the emerging market basket. So it's contrary to what the popular belief is.
Thanks for having me on the show. At 16.5 times FY16, I think market is reasonably valued considering that earnings are not there and growth hasn't returned. Of course, macroeconomics look very promising as you summarized just now. I think we've also been the most underperforming market in 2015 if you compare it with Nasdaq, Nikkei, Hang Seng. So we've really underperformed as a market, which hopefully poises us better for 2016. So even early signs of recovering in corporate earnings, I think will give us a substantial upside in the market.
Right. So Ritu, what's the right investing approach right now? I mean, should this dip at 7,600 be deployed as a buying opportunity? And if that is the case, what do you buy? Do you buy performers that have actually sort of waited the storm up until now, or do you start venturing into newer pockets? You know, one has heard the government invest in roads as well as the railway sector. Should you look at newer pockets like that, or for that matter, power as a sector?
The market has been fairly volatile in 2015, and I don't anticipate the early 2016 being any different. And in this uncertainty that looms, to me the right strategy is investing where you see earnings visibility, where you see earnings growth, where the profitability is robust and intact. And rather than a sectoral investment, so it's not a top-down approach, it's a bottom-up approach. Because even within sectors, the players and the companies are very diverse, the property multi-models have not been similar. So it is a very bottom-up approach. They should be balanced in the portfolio. In terms of sectors, I still like private sector banks, automobiles, pharma, but very selectively. Otherwise, the sector looks quite rich. Also in sectors like defense and roads, I would like to start investing in anticipation of 2016, starting to reward the fact that investments have started in these sectors.
Right. Ritu, if I look at the realistic assumption for 2016, growth will not come back in a hurry, both locally and globally. And at a time when growth is precious, why should value investing work? Growth has been the high point for this market. Growth stocks are trading at rich P multiples, but at least they are growing. Because if growth is precious, then value investing may not work.
Growth is precious currently, but as we see the cycle changing, the moment we start seeing a return in corporate earnings, the cycle has to change. And investing now at this levels in growth stocks is far too expensive. So as an entry strategy or a strategy to build a portfolio at this stage may not be the right strategy. So as you position for 2016, you need to make sure you're poised for a recovery, which I believe we will have. I agree with you, the recovery will not be a sharp uptick. It will be tepid. But the moment we start seeing signs of a clear recovery, I expect markets to outperform. We've had a time correction, we've underperformed the region, liquidity is still abundant, and so and economics have been very strong. So we are poised for a recovery, and I would hence have a mix where I see earnings and where I have a recovery story.
Okay, update on the Alkem IPO, and this one has got a massive subscription. HNI investors were absent in the earlier IPOs, but after the success of Indigo, maybe interest seems to be coming back. I mean, it's not a bad company. India's 5th largest domestic pharma company, 3% market share. They're trying to fix the margins. They're planning to move into the US market. So between Dr. Pathlab and Alkem, if I just have to talk about business valuations and the margin of safety, I just think that it's largely there with Alkem more. Even Pathlab also numbers are strong. So the IPO market is throbbing right now. Everybody thinks that this is going to be Indigo in making.
Yeah, and today you've got Narayan Hridale, the IPO press conference as well, which of course we will be cutting across to as well. And that should be an interesting one.
Depends on the valuations right now.
I mean, of course, yeah. Interesting business model.
Yeah, it's a very niche kind of a business model, Aisha, and what I just feel that will be the benchmark for the hospital sector per se. In India, you don't have too many listed hospital stocks. You've got an Apollo and you've got a Fortis. Apollo is very expensive. Fortis has got their own, challenges about capital allocation. Even the HNI investor is there. So a issue like this, which is a pedigree issue, where the promoter actually has more,
More of a CSR flavor.
Exactly,
as
CSR
opposed to,
flavor. I
yeah,
just get a sense that
capitalist.
this will do great for the benchmarking of the sector.
Okay, that's the update from the primary markets. But Ritu, just coming back, a slew of primary paper waiting to hit the market. Anything in particular that interests you? I know you can't talk individual stocks, but the sectors at least, which are looking attractive right now.
We've had, the IPOs you were talking of are quite promising, though small issuances, but attractive. And the good news is that financial savings have returned to the market, be it through mutual funds, insurance, etc., which is great news, which means we'll have appetite for the IPOs. And I hope we continue to have an environment where we'll see good IPOs over the next 6 to 8 months.
What is your assessment of the aviation space? I mean, according to Warren Buffett, if you invest in the aviation sector, you're committing a sin. But frankly, a lot of local HNI investors have taken a big bet in the aviation space.
I don't dare to argue with Warren Buffett, so I kind of subscribe to that point of view, and I have no exposures to aviation.
Even though crude prices are down, and this will be the biggest beneficiary for, this will be the biggest beneficiary of crude fall, you would like to avoid the aviation space?
Not that you're spoiled for choice in the aviation space. There aren't so many investment opportunities, but yes, for now I would like to avoid the aviation space.
For the longest time we've argued whether PSU banks are good or private banks, whether PSU banks offer value or private banks is where you want to, park your money, because at least they offer some degree of predictability. But currently the gap between private banks and PSU banks is at a historic high. So is there a trading opportunity which you can smell or sniff in the entire PSU banking space?
I agree with your observation, but no, I don't think I sniff a trading opportunity there. I'm firmly in the camp of private sector banks even now. I do not see the tides turning for PSU banks, be in terms of their interest margin, the market share that they've been losing, or the stress in the balance sheet, the NPA. Not much has changed. There continues to be a lot of challenges along the way, and I don't see that changing either in the next 6 months. And hence I would continue to be invested in private space. And as I said, I do have a keen eye on earnings at this point in time. And so I'm firmly in private sector bank space.
Okay, Ritu, good chatting with you. Thanks much for taking the time out and speaking with us today.